Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Surbhi Upadhyay and Pavitra Parekh. If Wednesday was woeful, today is a frightful Friday, right? For the markets, girls. We've tumbled 200 points on the Nifty yet again. It's a 1 percentage point plus cut coming through on the benchmark indices. The mid-caps are falling like 9 pins. The advanced decline ratio has 2,300 stocks currently in the green. Today, we've made a new 2023 low. The low today is about 17,666. We've breached the earlier 2023 low of 17,761. The new low today is almost 100 points lower than that. There are a lot of triggers, right? The decline that we've seen in Adani Group stock, the impact that it's had on banking names, crude prices have started rising since the beginning of the year with China reopening. The FIs have been relentlessly selling in the Indian markets in the month of January so far. The FIs have sold more than 23,000 crores. There's apprehension ahead of the budget and the FOMC policy next week. But if you and it's the start of a new series, right? February. And typically in the February series, we do see big moves in the market because it is the budget series. So quickly to take stock of the previous 3 Feb series, and this is Mangalam's data that I'm talking about right now. In the last series, February 2022, the Nifty was down 5%. Feb 2021 was a good budget and the markets rallied close to about 9%. So we typically do see big moves in the February series because it is the budget month. But Surbhi, so much of it depends on the kind of positioning, right? Yeah. Pre-budget and the impact then it'll have post-budget, and of course the nuances in the budget. And this time we are seeing positions getting lightened, especially given the fall that we have on Wednesday and today. I think a lot of the froth, the positioning in the market would be lighter. So if the budget complies and it's not a bad budget, maybe we can hope for some sort of a rebound.
Oh, absolutely. We've gone into the series with a lot of short positions. So before we talk more about the market, I think Shireen is now in conversation with the CII panel. Let's see what CII is expecting from Budget 2023. Over to you, Shireen.
Hello and welcome to the CNBC-TV18 special as we count down to the budget, the last full budget ahead of the general elections in 2024. All eyes are on the finance minister. Will Budget 2023 be a budget that builds on the previous year's announcements, or will the finance minister surprise the citizen and industry with some fresh triggers to accelerate growth? The Confederation of Indian Industry and CII, like every year, has come up with its recommendations for the finance minister ahead of the budget. From the economic policy standpoint, they say the key focus should be on augmenting both domestic and external demand, promoting investment and generating employment. Interestingly, CII is also batting for a cut in personal income tax. They also recommend standardizing holding periods and capital gains tax rates across asset classes. Well, to talk more about the mood that industry goes into Budget 2023 with, joining me on the CII panel, Sanjeev Bajaj, the President of CII, Sanjeev Puri, the Vice President of CII, Chandrajit, Banerjee, the Director General of CII, and R. Dinesh, the President Designate of CII. Gentlemen, always a pleasure. Many thanks for joining us here on CNBC-TV18. Sanjeev Bajaj, let me start by asking you, we're literally counting down now to the budget. What's the mood across industry? Do you expect this budget to consolidate on the promises made over the last few years? Or are you expecting the finance minister to pull out a rabbit from her hat?
What I would say, Shireen, is that the mood is cautiously optimistic. We hope that this budget will consolidate on the issues raised earlier and will take forward also a number of important issues. Starting with fiscal management is going to be key. We believe that we need to adhere to the fiscal deficit target of 6.4% of GDP for this fiscal, start moving to 6% in the next year, and then eventually get to 4.5% by FY26. And this is because our external situation is still quite uncertain. So we want to ensure a reasonable level of macroeconomic stability in India in these times. To do this, I believe that the government should continue to focus aggressively on privatization, and we can talk about some of those things more, but continue to do that and also focus on revenue augmentation as well. So we would like to see this. In addition, there are some of the key points. The government has been very focused on an investment-led growth strategy. We hope we continue to see that in the coming budget as well, with a 35% increase in public capex like the previous year. We need to continue boosting consumption demand, and that's where you mentioned about rationalizing of personal income tax levels. We see that it is people at the lower income level who got hit through the pandemic and higher inflation the most. And that's why what we're recommending is a rationalization at this lower income level. I think that's important to note. And lastly, we need to look at all this. We need to look at agriculture so that overall, whether in urban or rural India, we're generating more jobs.
Yes, I think the point that you make as far as fiscal consolidation is well taken. And because the government has the buffer on account of strong tax collections this time around, the expectation is that at least for the year, they will be able to meet the fiscal deficit target, if not improve it slightly. But the question is that glide path to 4.5%. But Sanjeev Puri, let me address the issue of consumption with you. As Sanjeev Bajaj pointed out, we have seen on account of high inflation as well as the COVID-19 pandemic, the impact being borne by the bottom end of the pyramid. Now, in terms of consumption demand, what do you believe the government can do? What are you hoping that the government does in the budget?
Okay, let me start off by saying that, as you know, there have been concerns on consumption at the rural end. Right? So I think we are seeing signs of pickup. And if you dissect the rural economy, it's really 1/3 rural wages, 1/3 farm incomes, and 1/3 off-farm incomes. So we are certainly seeing rural wages are up. We also believe realizations will be better as far as the farm incomes are concerned. So net, I think it's a positive. So I do believe that rural will pick up. Having said that, I think we are still not out of the woods. Overall consumptions needs to be boosted. And the fundamental pillar to that, I think, is really either through having more money in the hands of the consumers, which Sanjeev just alluded to in terms of the income tax at the bottom end, or the other is about creating jobs. And I think the PLI schemes have worked well. There's an opportunity to expand it, and there is some mention of it already through some large employment generation sectors, whether there is apparel or toys or footwear, amongst others. The second is, of course, to build on farm incomes, to exploit the full potential of agriculture. I think the trajectory that has been started in earlier budgets, with focus on inducing technology, with focus on aggregation through FPOs, the agri-infrastructure funds, I think those are the right steps, and we should build on it and maybe work out mechanisms through cluster-based to accelerate the progress, intensify investments in research and development. And the third sector, I think it's also an opportunity, given that India holds the presidency of G20, is also about the opportunity in the tourism sector. And that's been part of the strategy also of the government to showcase what India has to offer. Now, that's an area where India has tremendous opportunity, and we can actually work together, showcase it, and create the enabling interventions, so that tourism also multiplies over time. Tourism itself is, can create as much as 50 million jobs in the next few years.
Well, yes, that is, of course, that has been a long-standing demand that India put its focus on the tourism sector. In fact, I was having a conversation with the Civil Aviation Minister, Jyotiraditya Scindia, on Wednesday, the National Tourism Day, and the plan is to try and put together an integrated approach, combining civil aviation with hospital tourism and hospitality, and, of course, try and capitalize on the G20 opportunity. Infrastructure status is the big demand for the sector as far as industry is concerned. Chandrajit, Banerjee, what's the expectation? How different is this budget likely to be, given the fact that this is going to be the last full budget ahead of the general elections?
So, like what has been just said, Shireen, I would think that we really need to focus on consumption demand. And I think that's something that we would certainly expect to see. There has to be a focus on growth, obviously, pursuing an investment-led growth strategy is what we have been talking about, and the budget should actually keep that, increase allocation to capital expenditure by 35% like what it did last year, taking the total capex, so to say, to 10 lakh crores. And and as was said, we must also actually see much of it is focused on the rural, which will create that employment in the rural areas, boost rural demand, which has been sort of a concern while there is some pickup. The third thing I would think, which one would look out for in the budget, you know about the PLI. We've seen some good results of it. There has been some issues. We would look at that PLI getting extended, and also to look at something like an employment-linked incentive scheme. But tourism was one sector, but there are other sectors like logistics, retail, many others, newer sectors which was brought in the last budget, the ABGC, say for instance, animation could be, I would expect that in the budget, and the government could consider something like a urban employment guarantee scheme. That could be something important. And last, I think I want to mention one point. There has been recognition, and there has been a strong recognition towards business. And I think for this budget, it could consider something like a cross-ministry compliance commission to rationalize, digitize, as well as and decriminalize. That's India's regulations. 65,000 plus compliance requirements. Can we have something towards that? These are some of my expectations, which is quite similar, but in some cases, I thought I'll bring in some of the other points that I had in mind.
CB, the Urban Employment Guarantee Scheme has been a recommendation that CII has put on the table for the last several years. The government has veered away from acting on that. Even the employment-linked schemes that you talk of to generate employment, the tax incentives, that again I know has been a demand that CII has put on the table. But again, that hasn't found favor with the government so far. Let's see if this is going to be the year that things change. But Mr. Dinesh, let me come to you now and address the larger issue. One, of course, as Sanjeev Bajaj was pointing out, to ensure that macroeconomic stability continues. The government has done well on that, and all indications suggest that they would like to continue on the path of fiscal consolidation. But outside of that, on some of the pending things, privatization, especially bank privatization, etc., we haven't seen the changes being brought in. The bills haven't moved through Parliament. Is there now, a realization or an acknowledgement within industry that that's going to be parked aside for now?
Thank you, Sharon. I think the way I would look at it is that I think they have done significant steps, especially with the LIC going public, which I think has been a big step forward, maybe created the largest corporation out of India. So I think the intent is very much there. But considering the time we have and also the plans which have been put in place, I do believe there will be further continuation of that. And I think that's something which CII has been pushing for. But having said that, I think the public-private partnership is something which has been on the agenda for a long period of time. And that's something which I think we will really look forward to taking further momentum. And let us not forget, like we said, last year has been significant achievements have happened with the various initiatives which they've taken, not only with LIC, but also Air India and the others which have been closed. So for us, I don't think there will be a pause. I think it will continue. And that's something which from CII side, we will definitely be looking forward to continuing to happen. But having said that, on the public-private partnership side, especially with regard to the Gati Shakti initiatives which have been put in place, I believe there will be a huge opportunity for both the private sector and the government to work together to further the capex being spent, and also the utilization of the capex, which will again lead to further employment generation.
Welcome back. Just want to mention the pressure on the market still hasn't, gone anywhere. We're about 25 to 30 points off the lowest levels of the day. The struggle continues, and it's pretty real. And we went into the CII panel, so didn't kind of apprise you of everything else that's moving as of now. It is still banks. They are the biggest culprit. The bank Nifty, after a 1,000+ point decline on Wednesday, is again staring at a 1,000-point fall today. It's very severe, very heavy shorting going on in bank stocks, and a lot of that continues. And, guys, that's the only point that I wanted to make, that all of these shorts have happened going into budget. So a simple sort of scenario is, if it's a no-pain budget, then you'll get the reverse. You'll get the short covering. And let's not forget, the Fed needs to play ball as well. As long as the Fed doesn't provide pain, the budget doesn't provide pain, then perhaps. the bulls can heave a sigh of relief. But for now, from equities, we're going to shift our focus to commodities. Manisha Gupta is joining in, and today she is focusing on metals. Manisha, good morning.
Thank you for that, Surabhi. Well, yes, this is one sector that has continued to show very strong gains, even right now, because the dollar index is trading below 100 too, because we have seen very strong US data come in, whether it has been about the fourth quarter GDP numbers at around 2.9%, or it's about US durable goods at 5.6%. And the markets also are reacting to the US home sales, which have seen a second month of a gain. All of those factors really supportive for the metal prices. We anyway have started 2023 with very low inventories. The production curves have continued in Europe. Even as China is reopening, the production hasn't picked up very strongly yet. So all of these factors have been adding premium to the prices. Most of these metal prices are up anywhere between 10 to 25%, whether it's about copper, aluminum, zinc, tin, lead, etc. Especially for copper, which is seen as the one with most favorable fundamentals. That is a chart that is on your screens, which tells you that major academicians and agencies and the producers believe that going forward in the next 10 to 12 years, there isn't going to be enough copper. So starting with the S&P Global itself, and they think 10 million tons of a deficit is what we will be staring at by 2035. Bloomberg puts that number to 14 million tons. Goldman Sachs says 8 million tons of a deficit is what you could see by 2035 as well. But Codelco, which is a major producer of copper in Chile, says that 8 million tons of a deficit, yes, but much earlier at 2032 itself. Until you spend $150 billion as a spread out capex for the next 10 years, the world is staring at a lot of less copper going forward there, and the demand seems quite strong. So this is one metal which has continued to do quite well, and the markets do believe that an all-time high is not too far away in this year as well.
All right, Manisha, thanks a lot for getting us that update from the world of commodities. But with that, we are going to get into a short break now. When we return, we'll get some corporate conversations going. We'll speak to the management of Patanjali Foods to discuss the company's third quarter earnings, which were quite disappointing this time. Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. The market is still seeing sharp cuts, and a lot of these stocks are being really sort of dissed for their performance. So while you are seeing good performances also being rewarded, a lot of companies, the likes of Dixon Tech, you have even something like a Patanjali Foods, which is seeing sharp cuts after their Q3 earnings, really disappointed the street. So let's actually get that corporate conversation going then. Patanjali Foods is under pressure. It's down 5% reacting to Q3 earnings. The overall margin has improved sequentially, but year over year, there has been a sharp decline. In fact, the foods and FMCG business, while it continues to surge in contribution to the overall pie, that segment has seen a sharp drop coming through in the margins. So it's actually down to 10.3%. This is for Q3 of this year versus 25.5% that we saw in the last quarter. So to discuss the outlook and the quarter gone by, we're joined by Sanjeev Kumar Asthana, who's CEO at Patanjali Foods, to take some questions. Mr. Asthana, thanks a lot for joining us. I want to begin by exactly asking you that, why did we see so much weakness come through in the foods business? And do you think this is something that's likely to, hold going forward as well?
So we have projected always that, we should, our margin profile in the foods business is 15 to 18%. This quarter, it was about 11.03%. So we dropped from the last quarter. But that was an aberration because it was a result of an aggressive push that we had. We had a big boost in the sales of nutraceuticals, and we had a big push on the sales of the high margin products in the foods portfolio. But I'm anticipating from this quarter onwards, we should be pretty much on course for margin profile of 15 to 18%. We should consistently maintain that.
Okay, so margins to get back to that 15 to 18% band on the food side. So what about the oil business? What kind of volume growth do you foresee?
So margin profile, we continue from the demand side. We are doing way better than how India is progressing. So where the demand in India is progressing at 3 to 4%, we have grown nearly 8% in this quarter. But on a normalized basis, I think if we can maintain consistently a growth rate of 6 to 8% on the edible oil business, it will be a good result. And incidentally, we had a historical sort of a month in October. And we continue to almost, our volumes have gone up nearly 35% in 2 years. So we are anticipating a strong growth, but in the broad range of 6 to 8%, where we want to sort of do better than what the country is doing. And in that direction, I'm anticipating that the edible oil business should be on a strong trajectory as we continue to build on the brands and the distribution on that side.
Can you quantify that for us? And what can be an expected sustained rate of margins in the oil business?
So margins, as we've always maintained, that the profile is between 3 and 4% is what we should make in the business. This quarter, we did about 3.35%, and we expect that should be pretty much in that ballpark range.
Okay, should be in that same range. Mr. Asthana, if you're talking about the edible oil space, can you tell us what is the market share that you saw in Q3 for the edible oils, and when do you foresee reaching that double-digit kind of level?
So market share is constantly growing up. I think in 2 years' time, we should be past the double digits. And the plan is that we go towards, 2 lakh tons of sales every month. And which pretty much will put us closer to between 10 to 11% market share. And that is pretty much a safe territory for us to be in. But this number, we should be able to do it in about 2 years' time. It's not that next year we would be able to put that number on. Because the idea is that volumes, growth is not sufficient. The core requirement is that it should be growing profitably. So that's the main purpose of our, main objective in the oil business.
Fair enough. Could you talk about your other verticals? You had a 1,000 crore revenue target from Nutrela and about 1,400 crore from biscuits. Do you think you'll be able to achieve it? What's the progress?
So this, for example, this quarter itself, our food business is already 20% of the revenue mix. I'm expecting that every year it should continue to grow. So, for example, foods is growing at 15%. The range is different in different segments, but overall a 15% growth rate we are targeting in foods. And on the edible side, between 6 to 8%. So over 5 years' time, I think broadly we should be pretty much there. That 50% of the revenues will start flowing from the food business for us.
Okay, Mr. Asthana, what about expansions in the palm oil plantation side? What exactly are your plans, and how much could this perhaps aid your top line?
So oil palm, as I mentioned, we currently have 64,000 hectares in the plantation. Every year on a regular run rate, we are adding 6,000. Next year, for example, we'll add 25,000. The year after, we'll add almost 100,000 hectares. So most of the, the kick-in of the revenues of the new plantation will happen after 5 years, 5 to 8 years when it starts to kick in. But on the regular run rate, we are seeing a consistent growth of between 5 to 10% as the new plantations continue to, the plantations which were done 5 years back, they continue to start doing that. So we're expanding our capacity at the 2 units that we have in Peddapuram and Ambapuram. We are looking at new sites in Visakhapatnam. We are looking at an additional site at Telangana. We've already committed to put up a plant in Arunachal Pradesh and Pasighat, and we're exploring sites in Mizoram. So that is going to be a large push on the oil palm plantation side. Results you'll see in 5 years' time, but a regular growth of 5 to 10% year on year, that continues in the oil palm business irrespective.
One final question then. Sir, promoters own about 80.8% stake in the company. Will there be further dilution? If yes, by when?
So we are actively working. We are, waiting, for the quarter 3 results, and now they're out. So we'll now start working toward the marketplace. Our deadline was 31st December. We sought an extension, but we're expecting to complete it very soon because there's a lot of interest from investors to participate. So we should pretty much be on course for that.
Thank you very much, Mr. Asthana, for joining in. That's Patanjali for you. By the way, markets are again grinding lower, now back to the low point of the day. The low today was 17,667, and we're just about 6 points away from that. It will be a good time to invite Mitesh Thakkar of earningswave.com to find out what the charts are telling us. Welcome back. At the day's low once again, 221 points lost on the Nifty. The cut is similar to what we had in Wednesday's trade. The Bank Nifty is down 1,000 points. The cuts are getting deeper on the Adani Group stocks. Adani Ports, top Nifty loser, 9.5% lower. Adani Enterprise is down 5.5%. Remember, in its FPO, the anchor book was fully subscribed, but today the retail investors will have to decide on whether they want to participate in the big FPO. So that's going to be important as well. But there is a lot of selling that you can buoyancy in the markets and in the Adani Group stocks. Let's invite Mitesh Thakkar to make sense of the market fall today. Mitesh, your thoughts, any trade, and what explains this kind of a fall?
Good morning. So I think, what is important is that we were earlier taking supports around the 17,800 mark. I think this happened on about 6 times in the last few weeks. And today we have started breaking below that. So that contraction or that consolidation was happening now has given away, and the market has started expanding on the negative side. The first bounce back from 17,800 had gone to about 18,250. So it's about a 450 point kind of a win, which can happen. And the breakdown from 17,850, 800 levels suggests that 17,400, 450 zones would be testing. So I think there's some more decline left. In the worst case scenario, I think the 200 average, which is at about 17,290, that also could be visited. So broadly looking at more downsides in the next few days, pullbacks now to about 17,800 would be an exit or a selling opportunity. There has been a breakdown in most of the indices, barring the auto names. And I think, that's the one stock or one sector rather, which is holding out nicely. But otherwise, otherwise it looks like a market which will possibly, with some bounces, head lower in the next few days.
And individual stocks, Mitesh?
Yeah. I have one buy and one sell call. ITC is something which I like and is holding out very nicely in this declining or falling market. So keep a stop at 341, which is just below today's low. And look for targets of 357 here. While Jindal Steel and Power and IDFC Bank can be taken as short calls. So Jindal Steel and Power would recommend selling with a stop about 600 and a target of around 560 on the downside. And I think, banks are clearly going through some kind of a very strong cut and decline on the Bank Nifty index as well. So IDFC First Bank is a sell with a stop at 58 for targets of around 52.
Okay, got that, Mitesh. Thank you very much for all the calls today. Where the market's under severe pressure, we're practically at the day's low. There's absolutely no sign of recovery. Just wanted to point out the Adani Group stocks. The pressure is only increasing on some of these names, like Adani Ports is now down about 9.5%. So last half an hour, 40 minutes or so, some of these stocks are really sort of taking it on the chin. The other Adani names, that's Adani Ports, struggling at the day's low. Adani Total Gas, 18-19%. Adani Transmission, 16-17%. Adani Green Enterprises, the entire pack, severe pressure on the Adani group of stocks, along with, of course, the rest of the market. We are struggling at the lows of the day. Quick break on that note. We'll come back and discuss the fundamentals of the market. Satish Ramanathan of JM Financial Asset Management joins in. Welcome back. Pressure, pressure, pressure. That's what's happening in the market. Look at the list of losers on the Nifty. It's just kind of caving in as we speak. 200 plus points down. Bank Nifty's lost 1,000 plus now. No sign of a let up. 2.5% down on the Bank Nifty. ICICI Bank, SBI, HDFC Bank, Kotak Mahindra, and then you've got a Reliance to add to the woes. Contribution plate is in front of you. And there's apart from autos, basically nothing else is fighting on the upside. That's pretty much the shape of the market. Let's take the conversation forward. We have with us Satish Ramanathan, CIO, Equity at JM Financial Asset Management. Satish, good afternoon. Great to have you with us on the show. Difficult days in the run-up to the event. Is this just nerves? Do you think the markets will get back pretty much on track once the 1st of February is behind us? Or is the nature of the fall now beginning to perhaps concern you a bit?
Thanks for having me on board. A couple of things. I think what we need to bear in mind is that the Indian markets had outperformed for a significantly long period of times in 2022. And the other markets were actually falling way behind. And I think we are seeing a stage of normalization there. The second aspect is Indian valuations were very rich, and we're trading well beyond their median valuations for an extended period of time, and we are probably seeing that correction come through. The third aspect that we need to bear in mind is that the market was really on one leg, which was domestic inflows. And once the interest rates started moving up, I think people have become nervous on the domestic inflow part of it. And FPI inflows haven't really come in to support the market. So it's a combination of all these factors. I think markets rightfully are a little nervous, and probably the valuation pullback is a good thing for the markets.
Okay. Morning, and thanks so much for joining in. Thoughts on the Adani Group and the kind of fall that we are seeing today, Satish?
Not to specifically discuss any particular group or anything of that sort, but this is a market where leveraged companies would in general be much more volatile than before, and therefore it makes sense to avoid groups that have leverage and focus on free cash flow companies. And that's been our fundamental philosophy at the fund house as well.
Okay. Hi, Satish. Morning. This is Pavitra. What are your thoughts on the IT companies? Because a lot of them posted good results. Yes, there is uncertainty about, the outlook as far as FY24 goes. But do you think that these stocks could have probably already seen the worst and they're just going to move higher from here?
In terms of the IT sector, I think there is a little bit of a relief rally coming in because the results were far better than expected. And the US cutback in employees in the tech sector is probably an indication that the attrition rates that we saw last year for IT companies may come down. And therefore, the wage pressure which Indian IT companies have been facing for the past 3 to 4 quarters comes under control. So it's a little bit of a relief rally. Valuations still are ahead of themselves, but the mid-cap IT stocks have probably come to reasonable value proposition.
Okay, so you're finding value in mid-cap IT. Just a sense of the way you've constructed the portfolio right now, what would be top overweights? What is it that you're most convinced of at the moment, irrespective of the budget?
Right. Irrespective of the budget, we think that the capex story and the export story would continue. We think that the engineering export story, India seems to stand out as one of the few countries that can grab that opportunity. And that's one. And we are a little underweight on financials, even though we like the earnings momentum. But we think it's a crowded trade, and therefore we are a little underweight on financials and no equal weight on IT sector.
All right, Satish, we'll leave it at that. Thank you very much for joining us and taking us through your outlook on the market and some of these individual sectors as well. We do have to get into a short break, but before that, it is time for the CNBC-TV18 budget quiz. Remember, there are prizes to be won every day. We gave you the question at 9:14 a.m. today, but just in case you missed it, here is today's question. This finance minister asked SEBI in the budget speech to raise the minimum public shareholding in companies to 35% from 25%. And your options are Arun Jaitley, Piyush Goyal, Nirmala Sitharaman or Pranab Mukherjee. So send us your answers on Twitter. You can post your answer as a comment on the question tweet on CNBC-TV18 News and use the hashtag budget with CNBC-TV18. Hurry and send us your answers because we will be announcing the winner at 3 p.m. today. Hey guys, welcome back. You're still tuned into Trading Hour, and let's get you a special now. Like we've been telling you for the past few days, CNBC-TV18 has compiled a list of 20 stocks that you should watch for this year. This is a carefully curated list of companies that warrants a closer look in this year, that is in 2023. So Vivek is standing by at the big wall with an infrastructure player from the list. Vivek, which one is it?
Well, that's right. From the infrastructure power utility space, today we are focusing on NTPC. Now, NTPC in 2022 was a clear outperformance, led by increased traction seen for defensive utilities who actually enjoy a steady regulated business model. The stock surged over 30% in 2022 versus just a 4% gain for the Nifty. Now, going forward, along with the regulated thermal business that allows for steady earnings growth, some of the key triggers that markets are looking forward to from NTPC include the stake sale as far as the renewable energy platform is concerned and the green hydrogen opportunity. In fact, in an interview to us on January 5th, the management indicated that the renewable energy stake sale is on track and is expected to consummate by March 2023. In fact, the company is looking to monetize up to 20% in its platform by this particular fiscal itself. As per the management, the stake sale has already seen an encouraging response from potential investors, and the company is hoping to get valuations better than 1 year forward 10 times EV to EBITDA on monetization. Now, Morgan Stanley believes that NTPC's renewable energy business has significant business moats in India with advantages like the lowest cost of capital, lowest receivable days, and stronger land acquisition capabilities. On the other hand, CLSA is extremely bullish on the company's green hydrogen prospects. They believe that NTPC is a key player on India's entry into global green hydrogen market, and that the stock can see a 14 rupees per share upside if the company is able to secure 15% share of the green hydrogen market. Brokerages stay bullish on the stock, with Investec having the highest target price of 220 rupees a share.
Okay, thank you very much. Very interesting there, Vivek. But here's a standard disclaimer. This is not a stock recommendation. The CNBC-TV18 editorial team does not advise on trading or investing in the stock market. Any investor or viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor for their investment decisions. Well, with that, it's time out on Trading Up from the entire team. Thank you for watching. Halftime Report is up next.